we all learn together. Before I start with the three accounts, income tax computation disclosure standards, they are not accounting standards anymore. Earlier the name was tax accounting standards, but it is supposed to be nothing to do with accounting. But so the name was changed, and the nomenclature in the Act also has been changed in the 2015 Finance Act. Good thing about these ICDS that they are lucid, short, clear in the wording, but I don't know how far the meaning will be clear. But they are short. Basically, they have adopted the accounting standards issued by the institute, deleted all the explanatory paragraphs by and large, examples they have deleted, and only kept the principles and modified them to their advantage. That is how they have been prepared. In fact, the whole process has taken a lot of time. One of the prime reasons to have this that time tax accounting standard, now ICDS, was to deal with the situation that would arise when the Ind AS become applicable. But that has remained completely on sidelines. These standards do not deal with the situation when these ICDS become applicable. At the same time, Ind AS become applicable. They have actually done a common thing between running all through these standards is advancement of the revenue, and that has been the one common thread running continuously. Whether it is giving up the prudence concept, mark-to-market losses not permitted, so-called expected losses not permitted. If you see investment valuation, that investment valuation has to be done on a global basis and not script to script basis. All these things indicate they want to advance the revenue. I don't know what is going to happen. One of the objectives was to reduce the litigation. I doubt whether that will happen. It will actually open doors for more litigation. We will see where litigation chances are there. I mean, what one can possibly contemplate. But I don't think this is going to reduce the litigation. This is actually nothing but a backdoor entry or an unscrupulous way of amending the law without going to the parliament. So you actually change the law that all mark-to-market losses not permitted. The Supreme Court has held mark-to-market losses will be permitted. Prior to the amendment, which came as an amendment to the finance bill, capital grants were not income. Now they have brought the capital, all grants will be income. We have yet to see the amended bill. But these are the provisions, and this is the way I won't say necessarily the government, but the bureaucrats think. So I will give that credit, or at least that benefit of doubt, to the government or the finance minister. Now let's go to the standards basically. We start with the valuation of inventory. As I said, it is based on accounting standards, so AS2 is relevant. What has changed in the scope? In AS2, specifically in inventory of the service provider was excluded. There was a specific exclusion, while in this valuation standard, service providers inventory has been excluded. But possibly there is a drafting error, because if you see the definition of inventories or the scope, it doesn't mention the service provider's inventory at all. It comes as in the valuation of inventory, cost of inventory, it comes directly there. But the definition of inventory has not been changed. Definition of inventory remains the same. Possibly the thought behind it that it includes the valuation of inventory. Valuation of service providers in inventory is already included. But if you see the definition of inventory, it says assets held for sale in the ordinary course of business, in the process of production for such sale, and in form of material and supplies to be consumed in the production process or rendering of services. But per se, unfinished service was never regarded as a part of inventory. The other issue is whether does it become relevant, because you already have recognition of revenue in that service, how to account for, or rather compute income through services has been provided. If you compare construction contracts and services, you will realize possibly this is quite irrelevant. The two standards have not been read together, but if you read that, the service providers inventory would become quite irrelevant. We will come to that little later.
No, but if it is not included in the definition of inventories, only
I
the terms
appreciate,
of cost, etc.
but I would want
all interpret that it is applicable.
I agree, but what I mean, one may have to think why this is not law. Although it is part of the law in that sense, these standards may not be read as precisely as provisions of the law. And secondly, normally even if you want to interpret a law, you would not interpret a law to make a provision redundant. So, although it has not been included, one should go on the basis that the judiciary or the tribunals would say that yes, if it is applicable, and you cannot say the service providers is out of the scope, not defined, so it is the standard doesn't apply at all. Why did this services come into the task report? Category says that in India the services are an important aspect, and according to the best international practices, service providers inventory should be considered. And with that, I think they have brought in these service providers inventory. Then we go to the cost of inventory, which is a paragraph by itself. There are four types: cost of purchases, which is basically of the hard material; cost of services; cost of conversion; and other costs. These are the four categories of the costs which will go into valuation of the inventory. We will look at each one of these. Cost of purchases. This definition differs from AS2 because it has to align with 145A, which provides that when you have purchases and accounting of purchases, they have to be inclusive by inclusive method. All taxes, duties, etc., which are not going to be refunded, will have to be included as part of the purchases. So to be in sync with 145A, the cost of purchases will include all recoverable taxes, duties to form part of the cost. So VAT, central excise duty, to the extent it is not going to be refunded, will have to be included. Then other things remain the same, your trade discount and rebates, etc. will have to be excluded. But this one thing will have to be seen carefully, that now while valuing the inventory, one will have to take into account this adjustment. So far as 145 is concerned, effectively the way Institute has given the guidance note for accounting, except in some of the exceptional few cases of export, etc., the impact becomes zero. So it will not impact so much, but that calculation will have to be done to bring it to zero impact. As I said, cost of services we will deal with later. Cost of conversion, by and large the principles and AS2 has been followed. Allocation of overheads has to be based on the normal capacity. If actual capacity is approximates to the normal capacity, one can use the approximate the actual capacity utilization. Variable overheads on the basis of actual use of production facility. Now question comes when there is a more than one product, scrap, waste, material, etc., how to account for that. Normal costing principles have to be applied so that if there are joint products or byproducts, you allocate the cost on some rational basis and it has to be consistently followed. Scrap, waste material, if it is not of significant value, not very material, then you take its value at net realizable amount and reduce it from the cost of the main product. You need not independently value and show it as part of the inventory cost. Interest and borrowing costs. This is one item which has been as a part of sometimes a dispute. There is a specific now standard on borrowing cost. This standard refers to that if normally interest cost will not be included, in valuation of inventory. However, if the asset takes, or in that where asset here means inventory, if it takes more than 12 months to bring it to the selling condition, then the borrowing cost will have to be capitalized and added to the cost of the inventory. This is more explained in the standard on borrowing cost. What are the things to be excluded? Is abnormal wastage, material, which means the abnormal wastage could be of material, labor, capacity utilization, storage costs have to be excluded, unless storage costs are incurred in order that for future subsequent production process, this storage is necessary. Take the case of manufacture of vanaspati. What you actually do is you have refined oil. Refined oil is hydrogenated, and thereafter it has to be stored under refrigerated condition to get that granulated form which looks like ghee. Actually, it is not ghee oil. It is basically refined oil, hydrogenated and frozen. Now, in such a case where this mandatory 5 days of storage under refrigeration is required, this storage cost will form part of the valuation of inventory, but otherwise storage costs do not form part of the inventory. Administration overhead, selling costs are excluded. In AS2 there is another exclusion which is of distribution cost, which has been excluded here, possibly rightly. When you have, say, distribution channels, you take your inventory, say, to your depots, and that cost of transportation to the depot is in a sense distribution cost, which you have been normally including that in the valuation of inventory. So possibly distribution cost as contemplated in accounting standard is quite different, and that could possibly create confusion, and that is why this term distribution cost has been excluded in the exclusions in the ICDS. Then you have the other cost, which is allocation of overhead on some rational basis, and some of the direct costs which are part may not be raw material or cost of conversion, but all those costs will have to be included.
But in the case of, say, industry like wine and alcohol, where the wine has to be matured for 5 years, 10 years.
I avoided that example. It's a perfect example.
Whether interest cost has to be included because
yes, storage cost, and maybe if it is more than 12 months, and then if it is a direct interest or indirect interest, will have to be accordingly loaded on the valuation of inventory.
So that is one case where the holding period.
Yeah, I mean, it will say Scotch whisky 10 years, 12 years, 15 years, 18 years, and sometimes they have, if you have gone to any of the distilleries in Scotland, they may have 2 or 3 casks full of things to be opened to only after at a certain event, say coronation of Prince Charles. So they have kept in the lock and key, and it will be open only that time. So those things in such cases it will have to be loaded.
Now there may be situations where it's a floating stock, but the holding of the stock is usually higher. Now you can say, take a jeweler's shop, a retail showroom. There we find that the stock what the retailer is holding and the sales what is, the holding stock, the quantity amount is much higher than the sales. Suppose sales is say only 60% or 50% of the stock what is holding. In that situation, how you will be able to?
In that such a case, it will not be loaded. Neither the storage cost nor the interest cost will be added to the valuation of inventory. That will be written off as a period expense, because this base stock method,
yes,
which was there, which is now possibly many people may not know who have not learned all the methods of valuation, may not know also this method, but under this your turnover is there. The item doesn't take more than 12 months to prepare it for sale. The stock may remain.
Okay. Fine.
Because
once
it is
it's the
slow
finish,
moving,
okay,
it doesn't get added. Now, cost of services, what does it include? Basically labor and other costs of persons who are involved directly in providing services, supervisory personnel, and attributable overheads. The principle remains the same. But as I said, with ICDS on revenue recognition, making service contracts accounting or taxation of that based on percentage completion method, possibly this doesn't have any relevance at all. Because just as in construction contracts, when you recognize revenue and cost, you don't have inventory as such. In the same way, once you follow that method for service contracts also, there will not be any inventory except in minor cases which we will discuss when we go to revenue recognition construction contract. Only two permitted cost formulae under this. One is first in first out FIFO and weighted cost method. Now if you see the accounting standard under techniques of cost, standard cost is a permissible method. It is not a separate method other than FIFO or weighted average. But so far as tax report is concerned, there is a specific mention that standard costing can lead to litigation. To my knowledge, I have not seen any litigation on this subject. I don't know where the tax accounting committee thought of litigation and omitted this. But let us think whether it is actually not permissible at all. When you use standard costing, what do you actually do? As far as my knowledge goes, standard costing is basically used for costing the consumption to begin with, and maybe at times purchases also. But thereafter, all the variances are adjusted to the valuation of the inventory to arrive at the weighted cost itself. So, how do you say that standard costing does not give you the valuation under the weighted average cost method? And after all, even if you see this standard, what is the logic of valuation of inventory, or what is the objective, is to arrive at the fairest possible approximation of the cost. Even under this standard, although so-called materiality concept is eliminated under the ICDS and prudence is not there, but this approximation is accepted specifically in this standard. So, as I see it, the concept of materiality is built into this standard itself. And if I can show that using standard cost method, I am coming very close to the cost on the basis of cost and the weighted average cost method, I don't think standard costing would be really permissible, except because of this so-called comment of the in the committee report.
So
but
directly you have accepted standard costing. Indirectly, if you see, because what they have said is that overhead allocation will be on a specific standard of normal.
yes. But if you see the committee report, they have specifically dropped. But you see any public company's report for method of valuation of cost of inventory or method of valuation of inventory, they do nowhere say they use standard cost. They say either FIFO or weighted average, only weighted average. So even though you are using weighted average cost, which is arrived using standard cost, they also say weighted average cost.
Yeah.
Nobody says standard cost is a valuation of inventory.
And directly they have
I did not attend the lecture of Mr. Sarda for standard costing. Possibly my concept would have been more brushed, but this is what I remember. Indian marginal costing, not standard costing.
No, standard also.
He was known for standard costing. So.
Yeah.
So, do you have any different views, leaving aside this remark of the tax, the committee report, final report, giving reason that to avoid litigation, they have omitted standard cost as method of valuation. It is not actually method of valuation; it is a technique to arrive at the cost.
It is a method of allocation of expenses for arriving.
Absolutely.
Which indirectly itself they have accepted.
And all the variances are ultimately adjusted.
In fact, they are saying that variance should be adjusted only if your this thing is more than the.
Correct. So,
capacity. Your actual production is more than the capacity.
So all
It is the cost.
that is one part so far as overhead is concerned. But take a case of actual cost of the material.
It's not material we are saying.
So,
If there is excess material used,
Then
you have to write up because it is there in the
absolutely,
solution.
exactly.
So they are in fact saying that standards have to be standard cost.
So according to me, if somebody were to value it on standard cost basis and show that I have come very close to the weighted average method, I don't think that would be can be rejected.
Material which is used, wastage material, they are saying you have to exclude and you
I
have to
agree.
expense it out. That,
So,
in a way, if something is more than my standard, I am supposed to
So
exclude it.
the issue is like this: when I purchase or when I am recording my consumption, I may not record at different value. For a month, I will value say take cloth for use for make stitching shirts. I may say okay, it is 60 rupees a meter and continue. My variation may have been 62 rupees, 61 rupees of purchases. That variation is ultimately adjusted through variance adjustment. So it still comes back to the cost. There are two other methods specific, to be used in specific circumstances. One is specific identification method. Take a case where there is a very well-known modern art painter who has a say 3 by 2 painting, and I have made another 3 by 2 painting, maybe of the equal vintage, that is maybe in 2000. Both paintings are 15-year-old, 2 by 3 paintings. Both are equally ununderstandable. Both are equally one cannot make out what one wants to say. There is no splash of color. Whether my painting can it be compared with the painting of a well-known? So it can be. His painting equally something which cannot be understood by a common man will still carry much higher value. So that specific identification will have to be done. Normally this is also done in the case of diamond industry, where certain packets of certain carats, certain clarity have specific value. But there has been dispute on diamonds also, but otherwise so painting is the best example. If I were a dealer in paintings, this would be readily applicable. What are the criteria to use this specific identification method? Is the items are not ordinarily interchangeable. Painting of one cannot be replaced by painting of another, and or goods and services which have been produced and segregated for a specific purpose. Then you allocate that cost specifically to that. Don't mix it with the general. Retail method, common thing. You have a big bazaar. Certain, say all the shampoos will have maybe similar margin. May not be exactly same, similar margin. Or milk, which was in news for some time, where some milk dairies were giving lesser margin than the others. Possibly the retail method may be challenged. But otherwise, if there are common margins, then all those products can be valued by reducing from the sales value the common margin to arrive at the cost. One will have to take care in such a case if the sales value has been already dropped down to a net realizable value which is below cost. Then you cannot reduce that margin. You will have to take the sales value which is at NRV. Yeah.
E-commerce companies, they have stocks kept in various warehouses. In practice, I am told they are following it basically linked to the vendor. Suppose you have same products, shoes from Adidas and so on. Each vendor related costs are being earmarked to that valuation.
That is it.
So the same vendor also, there are 3 different types of products. Each one is linked to the specific vendor. So with the same class, there will be 10 items having different costs.
And different margins also.
Sorry?
And different margins as well.
Yeah, different margins. So in that case, what would the impact of this ICDS?
This retail method will not be. First of all, one will have to see whether that retailer, because many of these e-retailers are not actually owners of the goods at all. They are only aggregators and distribution. Where they are owners, retail method will not normally be applicable, except as I said, some of the common items where common margins are there. Say you have this Bania.com. there possibly on vehicles they could have the same margin. So, but otherwise, what you say Adidas or Nike shoes will have to be valued separately, and retail method will not apply.
So weighted average, they are setting a standard. Under the weighted average cost formula, cost of each item determined from the weighted average of the cost of similar item at the beginning and the end of the period should be average.
But weighted average.
Weighted average.
So,
See, what happens is, suppose we may have bought a particular product at 5,000 rupees and same product we would have bought from someone at 4,000 rupees. So suppose there are two products, 5,000 and 4,000.
same product or
Same product, same
yeah.
product. Now, the software generally needs to be bought for our supplier. Suppose from the stock what you bought is the product which was bought from A and not from the B.
Yeah, but their specific identification method will not be permissible. There you will have to use weighted average.
Yeah, so in that case, the resultant differences in some cases are very large,
But that will have to be adjusted. Because even under, you are at ICDS, even your AS would not permit that. AS, the product is same, just because your sources of purchase is different, does not give you liberty to value them independently.
Now, I would give another example. Today you say pharma or FMCG company, they get the thing manufactured from somebody and they manufacture it in their own company. Purchasing out is much cheaper, manufacturing cost is different.
They don't purchase it, they give it on toll manufacturing or sort of contract labor.
No, that is LL, but they do third party purchases. So LL is their own manufacturer.
Correct.
GP is, I have bought the product, I have manufactured it. One is at 20 rupees, another is at 35 rupees. This standard would require me to average it out.
That's right. But not only this and even AS would require
So that was the actual cost, and this was not that.
But actual cost ultimately weighted average you have to work out, or even for a person. One of the two.
So that is
But if the product is same, say closer is manufactured at Hindustan Lever doesn't manufacture. It's all loan licensing or their own satellite company.
His own manufacturer. That party is the only
Correct.
good, so manufactured by so marketed by.
That's all. So there you have to follow the weighted average. But that is not specific to ICDS. Even under general principles of under AS too, it will have to be done that way. How do you arrive at the net realizable value? So, net realizable value has been defined. It is the expected selling price as reduced by the cost of completion and cost of sale. So that is your net realizable value. It has to be worked out item by item. Now, when you say item by item, if you take what gold kind of situation, their item by item would be actually possibly item by item. And then there are panels which are manufactured in large numbers together. But if there is a unique piece of jewelry, it will have to be valued separately.
Non-standard and
But otherwise, if there are whole lot of goods are there, say 100 items or 100 shirts of the same type, maybe little variance in size, color, etc. But of the same material, same selling price, just the design is different. You can put them together and value them together. You may say, okay, 10% of these are damaged, so I will value them lower. 90% is the same value. You don't have to go item by item, shirt by shirt. They can be put together of the same quality. But the condition there is that they should have been manufactured for the same geographical location. The item should be similar, used for similar purpose. And individually they cannot be practically evaluated, which is fact. The issue of
item by item is what you are trying to probably tell is that you take cost of all the items, you take net realizable value as they have asked us in shares. They don't want us to do
exactly. So you cannot put trousers and shirts together or t-shirts together.
Class of goods.
Class of goods. And within that, if there are categories, see, something may be pure cotton shirt, Egyptian cotton would be different. Something may be synthetic material would be different. So those kind of segregation we have to do.
Ultimately in shares, as you said earlier, they have said the
Global valuation.
Global
That is completely wrong. That is going to create a problem there. Now, the issue also always comes of materials and other supplies which are used to be, which are proposed to be used in the production. Now, take a case that I have certain consumables or some of the, take a raw material that I have got. I have bought it. Concrete example could be crude oil products. Now, I have purchased crude oil at say 100 rupees a barrel, and today if I were to buy, the price would be say 80 rupees. Now, do I immediately reduce the value of that crude oil to 80 rupees because the market price has come down? The standard, including accounting standards, is no, you can't do that. You need to see, using this 100 rupee crude per barrel crude oil, whether when you manufacture the goods, whether you will make a profit or loss on those goods. If ultimately you are going to make even a small profit, you will have to value them at cost and not reduce price of 80 rupees. This applies to all the goods which are to be used in production process subsequently. But once you say that by using this good of 100 rupees, I will incur a loss, then you need to value them to arrive at net realizable value at the replacement cost. Because you are not a dealer in crude oil, you are not looking what you will get if you sell, but you will then replace it with 80 rupees, which is the replacement cost. So my today's purchase price would be 80 rupees, so I will value it 80 rupees. You cannot say if I go to sell outside this crude oil, I will get only 75, so I will value it 75. That would not be permissible. You will value it at 80 rupees. If you are going to make profit out of using those products and not going to make a loss, you continue to manufacture, value it at 100 rupees. If there is going to be loss, then you use the replacement cost. There is a specific source.
In the case of crude oil, you gave example, the price fluctuates moment to moment, day to day.
Yeah, but there you have to take.
So it is not there is no stability at all.
Absolutely. Most goods are highly volatile. Crude oil only you come to know. Gold also is on a daily basis it is changing, or hourly basis it is changing. But ultimately you take some standard rate or average rate on a particular date, on the date of valuation. That we will look at that valuation, how that is to be done at one point. What it says is that you have to use most appropriate or most reliable evidence at the time of valuation. I think I missed that. At the time of valuation. Now, at the time of valuation is what? At the close of your previous year, 31st March, or when you are actually valuing. If the standard is not clear, when you say at the time of valuation. So I would take it at the time of valuation means when I am actually finalizing my accounts. That is the time when I am doing the valuation as of 31st March. And why I take this view? It provides that if there is a price fluctuation in the prices or costs which are related to the events which give an indication of the condition which were existing as on the date of valuation, as on the close of the year, you need to take into account those conditions. So, the standard gives a very clear idea that you need to take into account events that have happened after your valuation date, so long as they give the or substantiate the conditions which are existing on the valuation date. So possibly this will apply. But now, issue of you say variation from hour to hour, that is not unique to ICDS. That is also there in air. But we have been valuing maybe your last purchase, last quote available, you take that into account.
So market value will be seen as on 31st March, no? As on the close of the accounting.
There is no concept of market value.
Net reliable, yeah.
Yes.
As on the date of
closing, but you take all the evidence available to you to arrive at that.
So subsequently, if there is a variation, then?
No, I would put it this way.
Yeah.
I have a godown in which I have grains stocked.
Yeah.
No, I have not opened. I know the 50 kg bags or 100 kg bags are there. In 25th April, I opened for in order to sell those.
Yeah.
And I see them, all of them are rotten. Obviously, it has not happened in only 20 days.
Mm-hmm.
So I understand that on 31st March, all this grain was rotten.
Rotten, okay.
So there I would then take a case that
Yeah,
I would
you
not
have
say
to
that
take a call there,
yeah.
yeah.
No, but now here in this case when there is fluctuation.
In
now-
wild fluctuation.
Yeah.
Yeah, they
Huh.
have jumped along
Take both
the
ways.
gold.
Yeah.
So, everywhere the change will be there, but the change will not be 2%. So,
What have we been doing all these years when you were auditing?
No, see, now in the case of gold it was not a problem. Now since this year there is going to be a problem and subsequent year also there may be a problem. The problem is because earlier when they used to follow generally average cost and all that, so the cost was always lower because the trend of gold was on the higher side. Since the last year, the trend is reversed.
If you see prices from 1980 to 81, because that's the day, you will see there has been variation, there have been drops also. Not continuously.
No, there were drops.
As on 31st
But
March.
there were drops, but the drop was, it could absorb. Now the drop is quite acute. If you
His
see.
case is that as on 31st March, what price do I take?
Yeah.
Am I right, sir?
Yeah.
So,
Yes,
what
sir.
price do I take?
Yeah.
Which is
Yes, this is the question.
I think possibly you would take your for that price will come into play only if you have to decide NRV. If you are arriving going on the cost basis because lower of the group, it doesn't matter. Issue will come only when you want to compare that as NRV.
One is less than
Whether
the
NRV
cost.
is less.
In that situation, what
And
was
in
it?
that
cost of
situation-
production.
And-
The inventory of crude oil as on the 31st March, no problem. But cost of production and the price is fluctuating.
But that to weighted average will take care. I buy something at 100 rupees, something at 102 rupees, 110 rupees, 90 rupees. That weighted average will take care. So that problem will come to decide NRV when the price variation is substantial.
So there what you say?
If it is, you are going to make profit out of that
Yeah.
higher thing, you have to
yes,
still go back on.
cost.
Otherwise replace.
Replacement.
That is only in case of raw material. If it is a finished product, then this will not apply.
Correct. That finished product is not. Finished product, your NRV is very clear.
NRV
Yeah.
means today is the crude plus my refining cost.
Correct.
Then I arrived at the
So
realization.
the issue comes for valuing crude oil.
Oil standard.
Your finished product, say maybe petrol or something, there it will not arise. Valuation of opening inventory. Last year's inventory should become the value of as on the previous year should become opening value inventory of the new year. Issue comes when I start a business during the year. What they have mentioned, cost of inventory existing when you start the business will be the opening inventory. Well, here there could be an issue of divergence between the Act and if you read the provision of the ICDS. See, take a case, I have certain shares valued at 2 lakhs of rupees, cost of which was 2 lakhs of rupees. Today I am deciding that I am going to start share trading business. This standard doesn't apply to share trading, but I am just giving an example. Say I want to start a real estate trading of plots. I have a land which is 2 crore and costing 2 crore and today's value is 5 crore. I convert this capital asset into stock in trade. So what would be the business form value or cost of the inventory for my business? That would be 5 crore and not 2 crore because that was the cost of my capital asset. So merely because on the commencement of business cost of the inventory which was existing then, if it was 2 crore, I think you will have to replace it by 5 crore, which is what the market value as on the date of starting of the business is. Change in the method of valuation, you cannot change except for reasonable cost. I think this is unnecessary change in the standard itself. The existing AS2 was very clear that you could change for better presentation, style or change in statute. Now reasonable cost, whether to give better presentation, is it a reasonable cost? That question will arise. And the change has been made here and elsewhere also to so-called avoid litigation. Actually, this is going to start further litigation. So whether to give better presentation, better true and fair view, if I change the method, whether that would be a reasonable cost, that would be a point of litigation itself. If they had said the change of statute for better presentation or any other reasonable cost, that would have been better. I don't know whether this actually expands or contracts or restricts the scope of option for changing the method of valuation.
You would say reasonable cost is offers a wide gate.
Wide gate for change or litigation?
Both. If the ITO does not accept the litigation.
Exactly. So if that specifies certain 2-3 things clearly, that for better presentation, change of statute, it would have been much easier. And then put if you want or any other reasonable cost. That would have been simpler.
So just in the transition provisions, that these are going to come to effect from 1/4/2006. Now as of 31st March, I am valuing my inventory without, as far as my accounts are concerned, without addition of tax and duty. Earlier what we used to do for the purpose of 145A, in the preceding we used to do the opening A votes of...
Same thing you have to do here also. You don't have to change the accounts.
Here what they have said is, as far as this is concerned, your opening inventory will be the inventory you have taken for the purpose of preparing your opening inventory.
For your tax purposes, what inventory?
For tax purposes.
Exactly.
So tax purposes also you will have made those appropriate adjustments under 145A. That should be taken. The next change, possibly this will bring certainty, but with the impact of heavy taxation, is when there is a dissolution of partnership, association of person or BOI, irrespective whether there is a discontinuation of business or no, the inventory will be valued at NRV. You had AL firm's case, Supreme Court decision, which said that if business is discontinued and firm is dissolved, valuation of the inventory should be at NRV. All the assets should be at NRV. There was another Supreme Court decision in the Shakti Trading Company where business was taken over at the time of dissolution and there was no discontinuation of the business. Supreme Court said NRV will not apply. Now in both the cases, NRV will apply and NRV is higher, the partnership will end up being paying heavy tax at that point of time without realizing the money. You will have to value all the inventory if there is a dissolution of the firm, EOP or BOI at the net available value. No, retirement may not have, if you have made appropriate provision, it will not lead to dissolution of the firm.
Yeah.
The law will apply or the standards will apply?
This is a matter of litigation only. That's why I said this is a backdoor entry to amend the law. So we will have to say that the Supreme Court only doesn't make the law, Supreme Court only declares the law. And Supreme Court has held in Shakti
Interprets the law.
as it existed. Exactly.
Yes.
So you could take a view that the accounting standard is in divergence with the law as it stands. Exactly. So you will have to go under that and say that in spite of this provision, if there is no discontinuation of the business,
whenever there is a contract, it's an act will prevail.
every standard says that at the beginning. So they contemplate there will be some provisions of the standard which will be against the law. Definitely.
This is the case of dissolution. Now, in case of a proprietorship converted into a partnership, and there are huge stocks. At that situation, the same principle will apply.
Possibly the same because there it was not of dissolution per se, it was because of the logic was of discontinuation of business. Now, if you are not discontinuing the business, if you are converting, there is no discontinuation of business. In such a case, it will not apply. But if there is a discontinuation of business and not in the process of conversion into a company or something, then you will have a problem. But if it is a conversion, there is no discontinuation of business, this provision will not apply.
Proprietor converted into partnership and huge stocks, cost
There
will
will
be
not
very
apply.
low. No impact.
No.
The same
Same
will
thing.
The other way of partnership is now these are two partners are there. One
That is
partner
NRV.
If business is
Yeah.
continued.
The NRV. Because the
NRV, standard, yeah.
says
That's what he
whether
said.
the business
No.
is discontinued or no. Once the firm is dissolved, very specific. Subject to, you have to take a stand that the standard is variance with the law and keep on fighting. Transaction provision is actually only one. If you have any time included in the inventory valuation your storage costs or interest costs etc., which are not otherwise now permissible as per say because inventory doesn't take more than 12 months to manufacture, then you cannot take benefit and reduce the stock valuation, inventory valuation by excluding that interest. If the stock remains on say 31st March 2016, if it remains in a stock, that valuation along with interest will continue. You will still test whether that cost is higher than NRV. If it is higher than NRV, you have option to go to NRV. Otherwise, the disclosure corresponds to accounting standard 2 and only accounting policies adopted, cost formally used, carrying amount in classification has to be given. We go to the construction contract.
So one important thing here is that now all these policies we have to actually write it down with our computation.
Possibly they all this will form part of 3CD.
3CD, yeah.
They will revise.
Suppose
3CD.
I am a trader who is not covered under 3CD. Not
Then there may be in the either it will come in the form itself with where business income is there, person is having business income, or
the
it
return.
will come under
Suppose
3CD.
if it doesn't come under the form, but as a person when I am preparing my computation, I will have to write all this
Where will you do that disclosure?
in my own accounting record.
That is no disclosure.
See, it's not, I am not question of disclosing.
But the
What we have said is that
disclosure.
Disclosure.
So disclosure has to come to the department.
Department,
See,
yeah.
whether they check it or not, it's a question, other question, they may ask at the time of scrutiny. I should
That
say
is
this.
fine.
No.
But according to me, it will come somewhere
Somewhere,
where it
yeah.
will go to the department. Either 3CD or to the form itself, somewhere it will come.
Form it may not
And I
come.
think they are already in the process of revising 3CD.
3CD, yeah.
But what you say is right, if I am not liable for tax audit, what do you do? Or say other sources. Everybody has some income from other sources. And this ICDS apply for that also.
Ah.
Yes, that will see when it comes. This construction contract, ICDS is one of the main things. When before going into the intricacies, if you see the accounting standard, there are basically three points where the revenue was postponed. One was when you could not contemplate or estimate the outcome of the contract in general or on overall basis, or you could not reliably measure the revenue of the cost, both, or there was uncertainty in the ultimate collection of the revenue. If these any of these three conditions were there, then normally the revenue recognition was possible. Now in most of these cases, the condition regarding being able to estimate the final outcome of the contract as a condition to recognize the revenue has been deleted. Similarly, whether I can reliably measure the cost of revenue, that condition has gone. The only condition has remained in certain cases is whether I am reasonably sure about the ultimate collection of the revenue. The condition which has remained is only for the earlier stages of completion, which should not exceed 25%. We will come to that. But keep this in mind, this is the basic change. These three basic changes have been there, which will, and of course, future estimated loss not to be considered for tax computation. So this standard will have substantial impact on some of the infra companies, say construction contract companies like Shapuri Palanji, L&T, or many of these companies will have substantial impact because of this ICDS, and maybe quite a few small time contractors as well. Basically, this has to be applied separately for each contract. There is a provision for combining and segmenting the contract. Those provisions, to a large extent, are in sync with the AS7 itself. But one will have to see whether otherwise, if the contracts are separate, one will have to find out profitability and accounting, or rather computation for profits and loss, revenue and cost will have to be done independently for each contract, and possibly ultimately ICD 3CD may provide to give those things as well, because there is a disclosure requirement to that effect. The contract also, the ICDS also applies for services which are directly connected with the concession. Actually, this was not necessary because anyway your revenue recognition standard is made applicable to all services. But this standard in toto applies to services which are directly connected with construction of assets, like engineering services, architect services, project managers. So all those persons, if they are not following cash system of accounting, will get covered by this. If the architect is an individual, he is practicing firm and following cash system of accounting, this will not apply, because ICDS don't apply to persons following cash system of accounting. But if it is a company or if it is any other associate following mercantile system of accounting, this will apply. It also applies to contracts for destruction, restoration. So construction includes destruction, restoration, etc. We could quickly go over when contract can be combined or when contract can be separated. Even if you make one single written contract, it may have to be split into more than one if there was a separate proposal for construction of a particular asset. Each asset has been subject to separate construction of each asset has been matter of or subject to a separate negotiation, and one could accept one and reject another, and cost of each of construction of each asset can be separately identified and measured. If these are conditions, then construction of each asset, even though otherwise as part of one contract, will have to be separated. Reversely, some contract will have to be combined into one contract, even if they are with more than one person. So, say for example, I am made a contract with now say Maharashtra Electricity Board is split into three: distribution, manufacturing, and one more, I think, transmission company. Now I may enter into three different contracts for construction of something, but if these contracts are such that they form part and parcel of a single project, negotiation has been as a package, and they have to be carried out concurrently or sequentially immediately, then they will have to be combined and treated as one contract. While I am constructing an asset, the person who has given me contract may say construct additional asset. In such a case, one will have to see whether this is really an independent contract or this is only extension of the existing contract. If pricing has been separately negotiated, if the design, technology, know-how, etc. are quite independent, and price that I quote or the person is agreed to pay is determined independent of my original contract, then this will have to be treated as separate contract, otherwise it would be considered a variation of the original contract. These are various definitions. I am not going through it because they are basically corresponding to the definitions contained in A7. Maybe we will change in wording here and there, but otherwise the principles remain the same. Then we come to the contract revenue. and contract cost and recognition of that is basically what is important. You recognize the revenue when it is reasonably certain that there will be ultimate collection of the revenue. Otherwise, you are permitted to postpone the recognition. But having recognized the revenue, then you cannot directly reduce it from the revenue. You need to write it off as a bad debt. So, having recognized the revenue, you cannot then adjust it by reducing the total revenue. You need to write it off as separately as a bad debt. There is a problem which I understand. I have not read the finance bill 2015 as passed, but they have made some change there. I don't know whether how useful it is going to be. The tax report said that once revenue is recognized and you have to write it off, it should be written off in the books of accounts and it would be allowed as deduction under section 36(1)(7). Now, as ICDS by their own admission do not have direct relevance to the accounts. More so in a construction contract, your recognition of revenue and recognition of cost are going to be quite different possibly than the way you are going to account it. Bigger companies may come closer to this because they may have been following AS7 in verbatim, but many small time contractors did not follow AS7 in that fashion. Now, having said so you will recognize the revenue which may not have been recorded in the books at all. Or even for a listed company, because AS7 substantially has a different condition for recognition of the revenue, you are required to postpone the recognition of revenue. You cannot reliably estimate the outcome of the contract or cannot reliably measure the contract. Since these conditions are not there, in books you may not recognize the revenue, but for tax purposes you have to recognize the revenue. So there will be no question of writing it off as bad debt in your books of account. So how do you claim that then? I understand you should claim only in the computation. It cannot be written off in the books. But then 36(1)(7) is not going to apply. But I understand there is a change in the finance bill for section 36 that deduction will be allowed for bad debts without writing off in the books. Now possibly we may go back to the old situation where we have to prove each time that this has come back. Today more or less the judicial decision has settled the position that once I write off bad debt as a bad debt, unless there is a fraud etc., that has to be accepted and I must be allowed as the deduction. But possibly the whole Pandora's box of whether debt has become bad or no, that controversy will get reopened again with this provision. Now what is contract revenue? First of all, it is the initial amount which is agreed upon. Then variation in the contract work, claims and incentive. These three are slightly different meanings. They have been well explained in the accounting standard itself. As I mentioned, the accounting standard and this, the difference is they have removed the explanatory parts. Now, I would see that merely because they have removed the explanatory parts or examples, if there is an issue where otherwise the wording of the accounting standard and ICDS is same, I can certainly fall back upon the explanatory paragraphs of the accounting standard and take a clue that for ICDS also it means the same. So whether it's a definition of claim or incentive payment or variation contract, I think those things one can go back and see what the accounting standards mention about that. Variations, there is luckily one thing that you need to account only when it is probable that they will result in revenue and can be reliably measured. This is the only one place and early stage of contract where this condition has been provided that you can postpone the recognition of revenue till you are sure that it will result in revenue and that revenue can be reliably measured. There are various opinions going that contract revenue cannot be revised downward. I do not know why such kind of opinions or views are being taken, possibly because the explanatory paragraphs in AS7 have been completely omitted, where there is a variation means it can be upward, downward, and because the contract quantity may go down. Say I have been given a contract for constructing or say plastering of 1 lakh square feet. Now that 1 lakh square feet possibly was an estimate, or the project building construction etc. undergoes a change, design undergoes a change, that 1 lakh becomes say 90,000. Will I not be able to say that my total contract revenue now is going to be lower? It's not 1 lakh in square feet into say 35 rupees a square feet, but now only 90,000 into 35. In fact, para 27 of ICDS clearly says that every year you need to relook at your estimate of cost as well as revenue. That itself gives a very clear direction that both estimates of cost and revenue can go down. It doesn't say it has to go upward. So many people say that revenue cannot be revised downward. I don't subscribe to that view. This has been one contentious issue in this ICDS. Earlier, when the retention money was taxable was subject matter of legal scrutiny. There are few decisions which are quoted, which mentions that retention money is liable to tax when it becomes due on satisfying the conditions contained in the contract or defects are removed, etc. That is why the retention money is kept back. Now the standard specifically mentions that retention money will form part of the total revenue of the contract. Now once having said that, once it becomes total revenue, it gets taxed on percentage completion method. So you may complete the contract and your retention money is due to you say only after 1 year, after satisfying the conditions or the plant reaching the specific performance or defects have been removed. But your revenue from this retention money will not be postponed by 1 year. In fact, it will start getting taxed immediately percentage completion is applied. So even before completion, by time of completion of the contract, the full retention money will have been taxed, even though you have no cash flow for that.
Claim for escalation.
Claim for
So escalation claims are often in dispute or go for arbitration.
So you will have to go on the basis that recovery of that, ultimate collection of that is not certain. If they are in arbitration, you have a very strong ground to say that collection is not definite, how much I will get is not sure, and you can postpone that.
So old solution continues.
Also.
What happens in case where the retention money is kept for a particular defect liability period? There is a defect liability.
The retention money has been defined to be that till the retention money is something which is kept out of the total progressive billing till conditions are satisfied or defects are removed. In spite of that, this will get taxed. Presuming that all these standards is in as per the law.
But
that's
you can make the provision for warranty and guarantee. Retention money is nothing but sort of provision for warranty and guarantee.
So you have that would be permissible. You will say that is my past, because we have to first say that is your past. Now question would be whether this is future past. That would be the case, or this is future loss. But what you say is right, that there have been consistently judicial decisions. It is not contingent cost warranty claim. If it is on the basis of scientifically arrived at provision, it is the current cost. So possibly that can work. So contract costs are basically something which is directly specific to the contract, or something which is attributable to contract activity in general and can be allocated. For example, if you have some consulting engineers or design department at the head office, and which is catering to various contracts, that would be cost of that will have to be allocated to various contracts. Cost specifically chargeable to customers. Sometimes you have in your contract that certain specific costs will be recoverable from the person who is given in the contract. Those when you incur, they will form part of the cost. And then allocated borrowing cost according to the ICDS on the borrowing. This is actually provision is absent in AS7, but borrowing cost actually provided for this. So they have made it in sync with borrowing cost standard ICDS. Issue is always cost incurred for securing of the contract. This is going to be a disputed item, particularly if you ultimately given the contract in the subsequent year. Because the standard provides, and but the provision is same in the AS7 also, is that cost incurred for securing of the contract will form part of the cost of the contract itself, even if it is not granted to you in given year, but these costs are identifiable and you have a reasonable assurance or expectation that the contract will be granted to you. If you don't have that assurance or you're not very sure about getting the contract, then you must write it off. Once you write it off, it cannot be brought back as part of the contract cost. It goes as a period cost and you will get deduction in one shot. You reduce the contract cost by incidental income, that is like scrap material, excess material that you may have ordered. If you sell that, so sale process will go to reduce the cost. It will not go to increase the contract revenue. But interest, dividend, capital gains not to be reduced from the cost, they will have to be separately offered for taxation. The reason given for that is that judiciary position is settled that pre-construction income is taxable. In fact, that is not settled position, and that really was relevant to the person who was constructing the asset himself. Say I am a company, I am setting up a plant for manufacture of fertilizers. In that course, what income I earn, interest, dividend, or say I am forced to invest in say national savings certificate, I get some interest from that. Whether that would be income or that would go to reduce the cost. That was the issue, which cases on both the sides. The issue was never settled, but they have applied this to the ICDS on construction contracts. The major thing is cost relating to future activity and advances to the subcontractors. Obviously, advances can't come as the contract. Now, cost relating to future activity. This is also something similar in the AS7. But how do I say? To give an example, leave aside most auditors are on cash system. But take a case that I have to do audit for year ended 31st March 2015. Typically, I know that I spend about 30% of my time in the planning of the audit, training my staff for that audit, and actual audit is done for 60% of the time, and then another 10% of the time goes in my drafting the reports, finishing the thing, which is not field work but back into my office. Now, this 30% of the cost which I incur, time that I incur for planning the audit, is it for future activity or is it part of the audit itself? So these disputes can arise in something similar in construction contract as well. But otherwise, costs which are related to future, possibly what they mean by future activity means actual construction work itself. That is how it will go. This I just had. Now, costs relating to future activity cannot be considered as one has to exclude it from the cost and one has to show it as an asset. But AS7 puts a criteria that should be considered as an asset only if there is a probability from this cost which you have incurred in respect of future activity will result in revenue in future. But this condition very conveniently dropped.
Sir, excuse me. Suppose a professional incurs some traveling expenses and he says that he is going to gain the knowledge by attending conferences or whatever, seminar or the training over there overseas, and is going to help me for my future work. So by this particular process, it will be capitalized.
Not capitalized, it will be not capitalized.
It will not be allowed.
It will
the year of
it will-
expenditure incurred.
It will be pushed to the year when you relate it to a particular contract.
But how can I relate also something?
So then, that is then you don't consider this as a contract of a particular thing. This is not allocable. This is a period cost. So cost which cannot be allocated, it is not related directly to a contract or cannot be allocated on reasonable basis, is not disallowable. You don't then go for percentage completion method for claiming that cost. You allow claim it in 1 year itself. Sometimes we have more as income tax officer than the income tax officer will have. Percentage completion method now become mandatory. The condition which was there, that once for recognition of contract revenue, I'll first explain how normally the construction contract accounting is done. It has nothing to do with progress billing, advances received. Let's go on the basis that I am accounting for contract revenue and contract cost on the percentage completion method. I am doing on the basis of cost to be incurred. So I estimate each year my total revenue, how much my total revenue is going to be. Say it's going to be 2 crore. So I see this, I have to divide this 2 crore revenue over a period of the contract on the basis of percentage completion method. I am deciding percentage completion on the basis of cost incurred. Now leaving aside future costs, this, that, etc., I have incurred say 1 crore as the cost. So that means I have, sorry, my mistake. I say that my total estimated cost is going to be 1 crore 50 lakh. So my estimate of at the year 1 is 2 crore as my total revenue, 1 crore 50 lakh as my total cost. So I am going to make a profit of 15 lakh over the period of the contract. This year if I have incurred 75 lakhs as my total contract cost, then 50% I have completed the contract. So I will have 1 crore as the revenue accounting and 75 as the cost, and I will offer 25 lakh as my profit during the year. This is year 1. Next year I go, because of variations etc., my contract revenue is say 2 crore 10 lakhs total revenue. My total costs are not now 1 lakh 50,000 but say 1 lakh 30,000. By now I have incurred 1 crore. So then I will again look at this. I take the percentage, reduce what I have offered for taxation 25 lakhs earlier, balance I offer in the current year. It's completely on estimate basis till contract gets complete. And you take estimate each year of your total contract, estimated cost and estimated revenue, and then compare it with the actual cost incurred to arrive at the percentage completion till the contract gets complete.
Excuse me.
Here I love
Here in this example, if I have incurred 75 lakhs cost, but due to some reason I haven't been able to bill 1 crore.
Billing has no relevance.
No, but I have not billed and I have not received also.
Doesn't matter. You pay tax.
No, but I may not have completed that much of work also, or
No,
they have that system of.
So then you go on a different basis to decide percentage completion. I said percentage completion, there are 3 possibilities given. Here in the ICDS there are given straight away 3 only. AS7 says there could be various methods which could be these 3. So 3 are illustrative, there could be many more. But ICDS gives only 3. Cost incurred, physical survey or physical work done. So if you have taken a contract for constructing say 1 lakh square feet and you have completed 50 lakh square feet, you have 50 and you are going on the basis of work done percentage completion on the basis of physical work done, then you will have completed 50% of the contract. Then you don't go for percentage completion on the cost. Then you take the cost, contract cost. For revenue you take 50%, now whatever cost is that you are delivered.
So I can take either
Consistently, then you will follow. Unless the type of contract is different.
because my revenue may depend upon what is certified by the architect as work convention. That certificate has not come, so I cannot bill.
Billing is completely different. Don't go on the billing. Although billing has some relevance, but they are not determinative. That both AS7 as well as ICDS say that the progress billing or your advances which are not the only determinative factors. So they can be an indication, but not the final.
So for the purpose of this finding the percentage completion, we should go by cost and not by the revenue.
Percentage completion either cost or survey or physical work.
Or second was?
Physical survey.
Survey.
But actually survey is not an independent method because survey will see actually physically what is done.
Yeah.
So I don't know why they put an even AS7 says that.
So what revenue I am going to generate with the cost what I have incurred, can I take that as my base and then proceed? Or I have to take my cost first and then proceed?
No. You have total revenue, estimated revenue.
Yeah, estimated revenue.
Okay.
For suppose now this year, what job I have done, say 50% I have done. So my
50% what basis?
of my total
What is the basis of 50%?
revenue on revenue?
No.
Say square feet wise. Suppose.
So physical work done.
Physical work
Okay.
done is there.
Now
Okay.
you take the estimated cost, estimated revenue,
Estimated revenue. Okay.
and 50% of that. Like
One second.
Possibly you will say cash payment, more than 20%.
Donation.
Yeah, so estimated cost obviously you cannot estimate the disallowance. That will be total cost which you estimate will be otherwise allowable for the. It's not clear, but I will go on that basis. When I am going to come to that at the end, how many of the ICDS will interact with each other, and you may have some more complex adjustments to be done. The condition which was there under AS7 that you need to recognize contract cost and contract revenues only when you can estimate the outcome of the contract reliably is gone. So here you will have to necessarily estimate the outcome of the contract, estimate the total revenues, total cost, percentage completed and offer for taxation. Under AS they have given very clear cut guidelines when for a fixed price contract you can say that I can estimate the outcome of the contract reliably, and similarly when costless contract what are the terms conditions to be satisfied. But this condition itself is gone from ICDS, so one will have to necessarily apply the estimate. As I said, recognition of the contract revenue and expenses, three methods are given. I do not think survey of work will ultimately decide what is physical work completed. It is not an independent method, but it is a method to, like technique to arrive at the completion of physical work.
And it is to be certified by
Just say, the ICDS doesn't say, but the third party evidence is always better. But ICDS doesn't have any such condition. But normally you have this.
to survey on our own.
You can employ somebody, you can get a certified by third party, say architect, engineer, etc. It is better to have that. Sure. Now, what costs you consider for percentage completion? If you are following proportion of costs incurred to estimated cost to decide the percentage completion, then only costs that reflect the work performed. Which is where I think the dispute can come, where I have spent 30% of the time in planning the audit. Have I done the audit? I mean, audit is not the best example, but say a company which is engaged in a consulting assignment. That issue will come up then. So for a company, it will be necessarily you have to follow mercantile system of accounting. So ICDS will apply, and thereafter you will have to have a percentage completion for the service contract, which will come later. Paragraph 21 of the ICDS gives how this recognition or application of stage of completion method has to be applied. This has to be, as I said, each year you have to again take estimate of the total revenue, estimated cost, see what is the percentage completion, and to that extent you offer the cost and the revenue. So each year this has to be done on a cumulative basis, reduce from that loss recognized in the earlier year or for surplus profit offered in for earlier year, and what is to be offered in the current year. So this also gives an indication that your contract revenue can go down as compared to your earlier estimate. There is no bar on reducing the total revenue estimate. Early stage of completion, when the outcome of the contract cannot be estimated reliably, contract revenue to be recognized only to the extent of the cost incurred. Now, AS7 has one additional line before that. After that, it adds, provided that you expect these costs to be recovered. That is very conveniently again removed. But take a case that even in the early stages, if I am sure that I can recognize the contract outcome of the contract reliably, then I can even land up in a loss, and that loss will be allowed. It is only where outcome of the contract cannot be reliably estimated that this provision comes into play. That I need to recognize the revenue only to the extent of the cost. But if I say that I can estimate the outcome of the contract, I can have a loss also. There is no bar on that. That till 25% of the work is completed, I cannot incur any loss. That is not so. But I can postpone the revenue if the outcome of the contract cannot be reliably estimated. And for whether contract reliability you can decide the outcome of the contract, I think one could fall back upon the guidance and the factors given in the AS7 to decide, which I mentioned for fixed price contract and for cost plus contract. There are specific criteria which are given. There are clear-cut deviations from here. Condition of 25% is absent in AS7. Under ICDS, early stage cannot go beyond 25%. Cost which can be expected to be recovered, that proviso is gone, and expected loss has to be necessarily accounted is gone. All through AS7, if at any point of time in the currency of the contract, if there is an expected loss, the whole loss has to be has to be provided for in the that year itself, and that is provided in para 35 of the AS7. But this is completely removed. There have been disputes on this in the allowability, but the standard is now very clear: expected loss not to be considered for computation. Transition provisions, basically two. First one effectively says that if my contract has started in the earlier year, whether I have accounted earlier on percentage completion or no, I cannot say that this contract started earlier, so this ICDS doesn't apply. You will have to do accounting or offer for taxation income in respect of contract which is begun prior to 31st March 2015, but which is going into the next year. You will have to do accounting on the basis of this ICDS. And if there is any contract which has been started even prior to that and it is continuing, then you will have to account for in 2016 and subsequent year, do the accounting on percentage completion method after taking into account what you have offered or claimed as loss or what you have offered for taxation in the earlier years. So you arrive at, okay, this is my profit for the year for 2016 total in totality. Of this, in 2015, 2014, so much has been offered for taxation. So current year tax is so much. Disclosure, surprisingly one disclosure has been dropped, and the method used to determine the contract revenue. All other disclosures continue, but basically contract revenue recognized during the period, method used to determine stage of completion, and so far as contracts which are in progress, costs incurred, recognized profits as reduced by losses, advances received and retentions. This is a comparatively small standard, quite except for rendering of services, to a large extent in line with AS2, AS9, but as a usual, certain uncertainties which require you to postpone the revenue recognition under AS9 have been dropped. Applies to sale of goods, rendering of services and used by others. So if you will see, it covers only interest, royalties, revenue. AS9 also covers only these. Rentals are conspicuous by absence. So how rental will be accounted on the general principle. So otherwise, even normally one would feel that rental also on the time basis we should be accounted. Does not deal with items which are covered by others. So construction contract, if you consider government grant also as a revenue, then government grant standard is separate. So these will not get covered by this standard. Import is sale of goods. Definition of when you recognize revenue from sale of goods is by and large the same. That is the definition of revenue measured by bond. Basically, it deals with when you transfer the risk and reward in the goods, you should recognize the revenue. Accounting policies and ICDS also provides you must go on substance over form, and even here effectively that provision has been brought in that where the transferring property in the goods and transfer of risk and reward do not get transferred at the same time, you recognize the revenue when you transfer risk and reward in the goods. Question comes of finance leases. There is no separate ICDS for finance lease. Take a case where the lease is admittedly a finance lease. So effectively, when I give out on a lease, I have transferred risk and reward. 5 years down the line, when the lease finance lease comes in, I may transfer the property in the goods technically. But otherwise, all risk and reward has been transferred. Can the department say that there is no separate ICDS on lease? So, accounting policy standard also says substance over form. This also says when you transfer risk and reward, you should recognize the same. So you should recognize the same in the current year itself and account for the profit. This could be an open issue. I think the department could do this very well. You recognize the revenue only when there is certainty of collection. AS9 actually has certain more conditions for recognition of the revenue, which are eliminated from here. It requires that revenue should be measurable and there should be no significant uncertainty about the quantum of revenue. You have a contract whereby you cannot still decide the quantum of the concession itself, then revenue has to be postponed. or collection was not certain, it had to be postponed, or it could not be reliably measured. In all these conditions, it had to be measured, but only one condition is kept here, that it can be recognized only when you have reasonable certainty of collection. Now, the provision which was there for sale of goods, that you recognize the revenue when you are certain about the collection, or when there are uncertainties involved, that is not specifically mentioned here. But it makes mandatory application of percentage completion method, and then says that provisions so far they apply of the ICDS on construction contract will apply to this also. So you have to go back to the construction contract ICDS. There you have a provision. Now, which provisions will apply? It doesn't say the whole standard will apply. It says mutatis mutandis, that is, so far as applicable, those provisions will apply. So now, again a dispute will start, whether can I borrow that condition that service revenue I will not offer for taxation if collectibility is not certain, or there is no reasonable certainty about the collection. Possibly I think one could take that view. But what we explained or understood about the construction contract will all, complete force apply here. All consulting companies, etc., which are mandatory have to follow mercantile system will get covered. Right? Luckily, most of us don't follow mercantile system, so we are out of it. Otherwise, we would have also come into this conversation. In fact, many years back, when the tax rates were after firm tax and partners tax, it used to go up to 75-80%. We used to follow mercantile. My firm used to follow. We shifted because it became impossible to pay 75% or 80% of the tax when 100 rupees was not received. At the right time, we I think changed. Even AS9 permits if the service contract is ongoing thing where you have to do a large number of repetitive acts, it permitted you to, under even percentage completion method, to offer the revenue or account for it on the basis of straight line method. That is dropped from here. Now only completed contract or completed service method is not permissible. Only permissible thing is percentage completion method. So far, interest, royalty and dividends. Interest is specific provision of accounting for interest on time basis. I think the issues are going to come here for many, even small individual cases. Say you have a bond, debenture which you have taken. Interest is paid in June and December. So January to March interest I will have to account for. I will not have TDS certificate. I may sell the bond before I receive the interest. How do I do this? And this will, my saving bank account interest is very often created in February and August or September. Will I have to account for that 1 month's interest now? These issues, not even earlier when mercantile system one was following mercantile system, one did not really think of these on these terms. One accounted for the bond interest when it was due. Then whether received or no is alright, but when it was due. But once you say on time basis, I don't have that concept of accrual there, but I have to go on the time basis only. And that can create.
Even if I am on cash basis,
No, cash basis you are
all individuals for income from other sources.
If they are following cash basis, they are out. But no, many people on the so far interest or etc. was concerned were taking say fixed deposit interest. They were taking certificates from the bank to claim that 10,000 year not, because if it was say fixed deposit, I get say 10,000 free. Actually, it is only for saving bank account interest. It is only saving bank. I may stand corrected. But many people were accounting that rather than accumulating and getting into a higher tax bracket. So they will have a problem.
But that interest accrued but not due is still not taxable. Accrued but not due.
Once you say time basis,
Time basis,
there is,
But then right to receive doesn't arise to that.
It doesn't, that is not material.
No, then this provision becomes a chargeable section.
So all
Then this is a
you can then argue that for a small guy, will you keep on arguing that this is against or in
because this is
in
once
this-
income is determined, then these competition standard will apply.
In
If it is not an income,
No,
that
it
should
is,
not apply.
it is income. At what point it is taxable is the issue.
No, I mean the competition. I mean it says the manner of competition. I mean how you compute.
Correct.
But first income should be there.
Income is there.
But it's not due, no? It's like to result of
So
the
you agree that income is there.
income is there. But
That's all.
I am
You
not
say-
right to receive that income.
That is different. The retention money also I don't have right to.
Right to receive, yeah.
For retention money,
I appreciate that there is a dispute there. I am not saying, but a lot of you need to think about it when you file the return or change first year itself to cash. That is the easiest way.
The TDS issues will come up. Wherever TDS is there.
All these
We
issues.
face issues in these are
No, actually,
deducting TDS as of 31st March, otherwise they will not get the revenue.
No, but there now enough cases are there where the bond holder on 31st March is not certain, they don't have to deduct. There are enough cases on that.
Circular is there.
Circular is there.
Implemented circular.
So far as dividend is concerned, they have gone to the Act because Act has very clear-cut provision where dividend is declared in case of final dividend, interim dividend, what is there, and 222 cases where certain distribution and certain payment, 222E is payment and all is CDR distribution. They are, how they are to be taxed is the Act provides. So they have just made a clear, simple provision that will be taxed according to the provisions of the Act. If all the ICDS would have been that way, nothing would have been
So
problem.
is this something like a old wine in the new bottle? The direct tax code has gone, so it has come in directly this kind of thing.
That was a new wine only.
No, but it has gone. So it has gone. So now it has come.
This is new poison, I would say.
Sir, as far as bond is concerned, now they have again said that if there is an interest component during my purchases, I will have to reduce that.
That is for securities trading.
Any income, in case of income recognition standards, they said.
But that is for the securities. What about my interest?
So probably can you draw an analogy from that? That
So you will have to draw something.
while selling also, this is a part of my interest. For the purpose of TDS and also if the problems arise.
So all these issues are going to be there unless you read two standards together, try to convince that this is logical to do this. You will have a
Because they
problem.
have allowed as this thing.
Same provisions of transition which are there for construction contracts will apply for service transactions. That if your service has started earlier, you account it on the basis of current rate. And so if you actually see what are going to be various implications on these are basically disclosure. These are all quite new because once you have sale of goods amount not recognized as revenue, then you have to explain that along with the uncertainty. Rendering of services, these are all the new disclosures which are there. There, once if you follow percentage completion, all these figures will have. But to actually work out the what is taxable is going to be a tough job and subject to many disputes. But this is how it is there. Maybe you think that it is a great opportunity, you have got more additional work. Question is whether you will be able to charge additional fees. That is, I think just now Mr. Lalwani showed me one of the big four how they have already started working as a revenue stream of that ICDS as a revenue stream. So something we should also learn out of that.
but for us it is additional cost.
But cost correct.
No,
You should never get any revenue without incurring cost. The question is whether you will get revenue. I don't mind incurring cost if I am going to get revenue.
in tax audit the number of items are increased from 30 to 32, 36 to 45, so of items.
Now you will more or less sign their competition effectively. what will be the overall impact? More divergence between book income and taxable income. Impact of that, some companies, particularly which are undertaking construction contract, will come under MAT. Because say I am expecting a loss, I provide that loss in the current year. I have a book loss, but taxable income. Now in the future, I will have book profit possibly, but taxable loss. So I will come under MAT. That will be plain simple additional tax which will be there. You will have to also see inter ICDS adjustment, like he mentioned that what cost do I take? For deciding total cost, whether I take only costs which are going to be allowable or costs which are book costs. Or take for example, you are valuing inventory. Do you take a depreciation overhead as per book depreciation or tax depreciation? You have these losses, mark to market losses this around, where all its impact will be. So all these issues possibly will come up, because till now possibly even the tax officers were not aware of these implications. More they go into that accounting aspects, they will also going to become more and more aware and get into these things.
And if they are confused,
Then it will worse. They will add. They are never confused. They are very clear.
yeah.
It is like this. When you have a case law, when there is a dispute. So we need to say at the assessment stage, if you give a case law, one officer told me, we need to give case law unless it's Supreme Court or Bombay High Court. I am going to add because there is a dispute there. So I will err on the revenue side. Very clear. So don't give me any cases. Convince me on common sense and law. Very logical thought, but anyway, I think that brings me to the end of presentation. We have a lot of work to do with the ICDS because minor changes, but they are going to make certain difference in the taxable income. We'll have to look at each one of them carefully, especially the foreign exchange, etc. standards. Even for your revenue recognition, wherever there is presumptive taxation, 44, AD, etc., you will have to take now revenue recognition standard into account to decide whether your turnover is exceeding that amount or not. So these are minor things, but we will have to take care on those things. And thank you for listening patiently and participating.
Thank you, Mr. Sanjeev. So my Google search was correct that he is knowledgeable, he is studious. There was lot of value addition in his presentation. Friends, many years back, Sanjeev has written a RRC paper also for Chamber. Now I think after a long time he is on our Chamber's platform. But after listening today, I will have to trouble him again. Before I request Dinesh Bhai to propose a well-deserved vote of thanks, announcements. On 9th, today we have covered 3 ICDS. On 9th June, we will be covering other 7 standards, wherein the speaker will be Mr. Ravikant Kamath from Ernst & Young. And again on 16th June, there is a study circle meeting. The details will be announced later. Only you can book your date for 16th June. For study group members on recent judgments, on 11th June, we have a study group meeting which will be addressed by Mr. Gautam Nayak. And as far as corporate committee announcement is concerned, there is a valuation course on 5th June, 6th June and 12th and 13th June. All are requested to register for the same. With this, I request Dinesh Bhai to propose a very well-deserved vote of thanks.
I propose hearty vote of thanks on behalf of Chamber of Tax Consultants to C.A. Sanjeev Bhai Pandit, explaining in detail the accounting standard of income tax computation and disclosure standard, ICDS, that is popular income tax standard, valuation of inventory, construction contract and revenue recognition. Today's talk was very helpful to us. Thank you very much and sparing your valuable time for us.
Good, thank you. खूप डिटेल मध्ये केलं. Comparison वगैरे that was very interesting.
We are a BC only.
हाँ.
Wearing textile. Now you can have some. Yeah, see.
Yeah.
It will take time to reach home in the winter because we feel like
To go out for dinner actually.
Acha. Okay. With the ICDS, there is usual reconciling the decisions, reconciling the rules taken.
Nobody knows, even officer will not know.
This will all come somewhere in 2018-19 when the scrutiny will happen for the
We will have to start by now. We will start
after 3 years, 4 years.
Does it applicable to
to
builders?
builders no, really no.
Because builders, when I have attended this ICDS when posted the Article 366 of the Constitution defines work.
Yeah, listen, this issue is even under service act they are there. So, one of the decisions under Consumer Protection Act also considers as service. Bill of goods is not covered by so, but I think these are slightly different enactments. You can't go on.